Good afternoon, everyone. Good morning, everyone. Good evening, everyone. And welcome to the 8th session of MOOC 11, Cryptocurrency and Central Banking. I'm delighted to be back with everyone. I hope you had a great few weeks with Andreas, and look forward to the remaining sessions of the course. So I think this is a super interesting topic, a topic that is actually very topically relevant now. We see a lot of discussion about this topic happening in the broader financial world. I think there's a lot of questions about how this will work, not work, when it will happen, and so on. And so I think it's a timely and relevant topic. And I think the questions are in the right direction for this topic. So I'm going to aggregate some of the questions and talk about some of the topics on a comprehensive basis. And before I answer a question, I'd like us to think through what a central bank digital currency might mean. What is it? Like, how do we think about it, and how does it work relative to normal currency? Now, let's start with a country that doesn't have a central bank cryptocurrency or blockchain-based currency. We'll take the United States. Most money supply in the United States is today digital, right? Like, if you go to look at your bank account, the bank is not storing bundles of cash that they're giving in and out, right? Like, your balance is just represented in a database on a computer. The primary representation of money today is already digital. So when we're saying it's a digital currency, I don't think that's actually the important thing. I think the important thing is it's a ledger-based currency, a blockchain-based currency, a central bank-backed cryptocurrency or blockchain-based currency, something along those natures. Because digital it's already the case that most transactions by volume, most money supply by volume is already represented in digital form. People over-index to cash because you see cash in your day-to-day life as a consumer. So you might still use cash to buy coffee or to chip in $20 for a pizza with your friends or to buy a drink at the bar. And so cash is still around in our lives. But that's not the majority of the money supply, right? Like, most of it is already digital. And so I think it is important, because I sometimes still see these theories that say, oh, look, a cryptocurrency is going to be so much better. A central bank-backed cryptocurrency or even a private cryptocurrency is going to be so much better than existing money. And then they proceed to describe all the problems with cash. And sure, but we have solutions to the problems with cash on the whole through digital representation of, normal sovereign state-backed money. When I send a wire transfer from the U.S. to Cyprus, it's not that someone at J.P. Morgan Chase is taking cash out of the vault and putting it in a suitcase and getting on a plane and flying it to Cyprus and giving it to the Bank of Cyprus, and they're putting it in the suitcase. We covered this at a different point in the course, but it is correspondent banking, and basically people are just making debits and credits in respective systems of what they owe each other, and it all works out in the end. So I think the important part is not the digital part, right? I think the important part is that it's digital and it's open, or it's digital and it's decentralized, and it's digital and it's represented in an open data structure. Because today, when we say it's digital, when we say that, I don't have a computer shit. When we say that there's a digital representation in Chase of your bank account, you don't have direct, unintermediated access to it. you have access to it subject to the access controls of Chase. You have to identify yourself and prove your identity, and then they say, okay, yeah, you're Antonis, and are you authorized? Yes, you're authorized. And is your account active? Yes. And has it been suspended? No. And has it been swept up in any anti-money laundering topics? No. And so if you clear a variety of hurdles, then you get third-party intermediate access to a digital representation of sovereign currency, right? You can't, what you don't have today is direct access to portable, decentralized, digital sovereign money. You do have direct access to portable, decentralized, non-digital sovereign money. It's called cash. So you can hold cash with no counterparty risk, with no gatekeepers, with no intermediates. If I have $10 in my pocket and I have a $10 bill, I'm holding it directly, and I can decide to give it to someone else, and then they're holding it directly, and they can decide to give it to someone else. And so it exists on the cash side. And so when I ask myself, what do I imagine a central bank backed cryptocurrency or blockchain based currency, what would it look like? The general model I think about is the electronic cryptocurrency version of cash. I actually think that's what currencies like Bitcoins are. But Bitcoin is that. It is cash just electronically, and it's non-sovereign. So let's say the United States decided they wanted to do this. I believe the first thing that they would do is not invent a different currency. I don't think they would say, we normally use the US dollar, but for this purpose, we're going to use the US doubloon. And the ratio of doubloons to dollars, or the exchange rate of doubloons to dollars, is going to be X. That's not how it's going to work. It is going to be a dollar. It's going to be the same US dollar you otherwise use in any other mechanism. And why would you do that? Well, you would do that because the US dollar has developed a long history and reputation as a unit of account and a medium of exchange and a store of value. And so you'd want to leverage that. That's the whole point of having a central bank backed one, that you take advantage of all the advantages of successful sovereign currencies. So it would be a US dollar. So now, how would I do this? Right, to ask this question, I asked this question in one of our courses. I think it's an interesting exercise. Like if you actually got into the details of how would you issue your crypto dollar? What I would do, I think, let's say the US total money supply is $1 trillion or something. I would start with 50 billion, something small. You're not going to use this to change, I believe, your monetary policy. If the United States wants to pursue a certain monetary policy, and that policy is inflationary or deflationary or expansionary or not, there's no reason to believe that the United States would change their point of view just because they're making US dollars available through a different technological infrastructure. So if I wanted to have this much money supply outstanding anyway, I wouldn't change the total amount. I would say I'm issuing 50 billion worth on my blockchain. And after I've done that, I would adjust the money supply of everything else to get up to the same kind of amount that I'm looking for anyway. So then how do you manage price stability? Because here, it doesn't make sense that you're going to have a digital US dollar. A digital US dollar is the ultimate stablecoin. digital US dollar should trade exactly similarly to a non-digital US dollar. So what I would do, I think, if I was a treasury, I would say that I am a buyer of or seller of these dollars at exactly $1. So what that means is that it's hard for the price to get out of line, because then someone will arbitrage it back into line. Let's just walk through the mechanics. Let's say your digital US dollar falls to 95 cents. And let's say, the Federal Reserve will always buy them at $1. I will come buy it at 95 cents to sell it for $1, and I'll make 5 cents of free money. And then one of you, because you're smart and bright and monitoring, say, well, I don't want Antonis making all the money. I'll be willing to do it for 4 cents. And so you bid 96, and then someone else says, well, heck, this is free money. I'll do it for 3 cents. And then 2 cents and 1 cent, and we've brought the price back to where it should be. So if the Federal Reserve is a buyer and seller in unlimited amounts at $1, I believe at a first approximation, you will have a stablecoin. Now, why did I say at a first approximation and not 100%? I'll answer that. The first, I would say the Federal Reserve is the only true provider of a US dollar stablecoin, right? Nobody can be more credible than the Federal Reserve in saying, if you bring me one crypto dollar, I will give you one regular dollar. Nobody can be more valuable, but more reliable. The single most reliable party to be able to give you $1 is the Federal Reserve. Would JP Morgan Chase be credible? Yes, they're very credible. They're a big company. They have a lot of assets. They're healthy and they have a very high credit rating. And so if they say one of my JP Morgan coins is worth $1 and you can exchange it for $1, it is a guarantee that is 99.99 something percent likely to be honored. But because any private company, the risk is never zero. You can look at the credit default swaps for JP Morgan and see what the market thinks is the risk that JP Morgan will default on their debt. And whatever the number is, even if it's very, very low, it's not zero. So there's always a touch more counterparty risk for even a JP Morgan or else than for the Federal Reserve. Even if the difference is small, I think from a conceptual perspective, it's important to understand that difference. And certainly, I think this is even more so true for an algorithmic coin, right? Like an algorithmic coin, I think it would be very, very difficult for someone to definitively prove in advance that under all scenarios and with people attacking it, because people will attack algorithmic coins to see if they can break the peg because they'll make money, that it would perform correctly. And the history of an algorithmic coin is basically trying to run a fixed rate currency. It's trying to run a peg. And the history of that, even in sovereign currencies, even with nation states backing them, is poor. There's the very famous event where George Soros broke the Bank of England's peg and made £1 billion in a day by forcing them off of the fixed exchange rate they were trying to maintain. And so this is, I am significantly skeptical that an algorithmic-based stablecoin can deliver under all circumstances, or can give comfort that it will deliver. Right? Because in advance, you need to believe that it will deliver. Well, how do you give that comfort? I think it's complicated. I think it's difficult to give that comfort. And if you have a reserve-backed stablecoin, Well, that should work, but what you actually have is not a US dollar. You're a creditor of JP Morgan. You have something like a loan to JP Morgan. And that might, in practice, almost all the time, trade like a dollar, but it is slightly different than a dollar. Whereas if you're a central bank, crypto dollar, I think you're pretty darn close to a dollar because the central bank can more or less guarantee that it's going to give you a dollar. Now, why do I say pretty much and not 100%? Well, because there are always some slight market distortions, because there's always a little bit of friction between the theory of how you can arbitrage these things and the practice. And these things happen even in non-crypto. In certain trips I've gone over the last 10, 15 years in developing countries, I pull out cash, I pull out US dollars, and there is a distinct preference for a crisp, new US dollar to an old, dirty, wrinkled one. And I believe there's a distinct preference to the point that people would pay you just fractionally more for one than for the other. You don't notice that in the United States because in practice, this isn't real. You could take the dirty US dollar and the wrinkled US dollar to the Federal Reserve and get a new US dollar. But if you're in a market in Old Delhi, getting to the Federal Reserve to exchange your wrinkly US dollar for a crisp US dollar is expensive. And they know the other vendors prefer the crisp ones, and so I suspect a clean piece of cash trades slightly more than a dirty piece of cash. And here I mean like physically dirty, not in the money laundering sense dirty, actually physically dirty. Let's say you're someone who is doing nefarious activities. You would pay more for a US dollar that has a clean provenance than for the US dollars you have in your hand that maybe not have a clean provenance. So if I have gone and sold illegal drugs to someone and I have US dollars from illegal drugs, in practice, and this is the classic money laundering case, I might be willing to run a laundromat or a restaurant, a cash business, maybe run it at a loss, so I can filter my US dollars through the cash business so I can get US dollars at the end of it that look like they came out of a legitimate business. And even if I lose 30 to 40% of the value that way, it might be a good trade. So it's interesting because everyone would say normally, and I think it is normally correct, that US dollars are fungible, but US dollars situations specifically are not. The US dollar of a drug dealer, of which he cannot in effect deposit in a bank because he can't fulfill the anti-money laundering requirements, is worth less than a US dollar that shows up in the bank account of a restaurant that there can be a justification of how it got there. So I believe these same things will hold for the crypto US dollar. That if there's someone who needs crypto US dollars in some context where they might not have easy access to the exchanges that convert back and forth to non-crypto US dollars, they could trade at a premium or a discount. Let's say you're in a sanctioned country. you might pay a premium to get a hold of crypto US dollars, because now you have a well understood unit of account. You can move it around the world, and if nobody would otherwise exchange your local currency because your country is sanctioned for those crypto US dollars, you would probably pay a significant premium to get your hands on those. So to recap, I think a central bank-backed cryptocurrency would be the closest thing that you can get to a stable coin relative to that currency. It would be the closest thing that you can get to a fungible stable coin relative to that currency. But there will be situation and context specific factors that at any point in time, it's still never going to be perfectly fungible, because even cash itself, from a context specific scenario, is not perfectly fungible, even though the cash itself is fungible. Now let's go to the next topic, and I think this is going to be the major difficulty central banks will have with crypto coins. Will you be able to go get your hands on US crypto dollars without going through the full AML KYC exercise? And will you be able to use them, because it's the logical follow-on from this, without all the requirements of banking regulation? So, in other words, will they let you use them like you can use cash? Will you be able to say, I would like to get some cash, and then what I do with my cash from moment to moment, nobody necessarily has any visibility on, and it certainly can't be easily censored. So if you have, whereas bank accounts can be easily censored. If person X gets sanctioned, and the view of the United States of America is that you should not send money to person X, they can ask the banks to reject any transfer requests to person X. They cannot easily, it might be illegal to give them cash, but it's physically possible to give them cash. If you were going to do this as a Bitcoin type clone, you would not have this AML KYC built in. And I think, even though it's the exact same thing like cash, I think central banks are going to have trouble with it. And why are they going to have trouble with it? Well, central banks, for two reasons, don't love cash. One is all the anti-money laundering reasons. The other reason is, though, it prevents them from applying negative interest rates. And we'll come back to that in a second, because that's relevant. And so I think in their long-term, bit-by-bit ground war against cash, because there is for sure a central bank ground war against cash, I believe there will be resistance to saying, oh, we're bit-by-bit eliminating cash, and now we're going to go recreate it in digital format, right? Like that's something that I see banks having a real problem with. And so I think you wouldn't fully get a Bitcoin-like central bank-backed cryptocurrency, even though in theory it is possible, right? Like you literally just clone Bitcoin and say, I will trade any one of these tokens for a US dollar. I'm a buyer and seller at $1. You'd make a market, you'd keep them stable, and so on. But I think they'll have trouble on it for these two reasons. They're going to want to apply some level of control on who gets their hands on them. And then there's this interesting question about interest rates that we'll address more generally. So let's take that as background. And now with that as background, let's think about some of these questions. In the case of wide crypto adoption, how will that reduce the ability of central banks to control short-term interest rates, and how central banks can continue to implement their monetary policies? My practical answer to that question is that even if central banks issue cryptocurrencies, they will not issue them in sufficient number to prevent them from conducting the normal monetary policies. So this is point one. Absolutely related question. Do you agree that a central bank digital currency could be a chance to achieve a financial reform to replace the current fractional reserve banking system by a full reserve banking system controlled by the central bank? I agree you could do it. I disagree that the central banks actually consider this a desirable outcome, because the central banks could do this now. How could you do this now? You could offer businesses or individuals access to a bank account at the central bank. And what features would that bank account have? Well, it would earn the same interest that commercial banks earn at their deposits with the central bank. It would have zero counterparty risk, because the Federal Reserve is not going to default. It's not doing fractional lending. And you could do basic transaction processing. That could be done without a central bank digital currency. It has not been done. And then even when people have tried, it has been blocked. So I'm going to give you a couple of links. And these links are relating to a company called, I believe, yes, TNB USA Incorporated. And TNB stands for the Narrow Bank. And I'm just going to read you part of the description, because this is brilliant. The Narrow Bank is run by the former head of research at the Fed. And it is the following. You start a bank, you take deposits, you invest 100% of those deposits in reserves at the Fed, and you pass on the interest, or almost all the interest, to your depositors. That's it. You don't do loans. You don't make investments. And you can give depositors, as it says here, a checking account at a bank that is immune to financial crises, bank runs, and bad investments, and a checking account that is fully backed by the Fed. So these guys actually applied to the Federal Reserve to get a banking license to do this. And the Federal Reserve rejected their license. And now they're suing the Federal Reserve. And that's an ongoing story. There was some more news recently. I posted these from last September. And one of the reasons they rejected it, and they said it openly, it was that they weren't sure if the growth of, they were afraid it would work too well. And if it worked too well, it would limit their ability to conduct monetary operations. So we don't have to guess what the Fed's answer to this question is. Do they want to use digital currency to go to full reserve banking? they had the opportunity to go to full reserve banking without changing anything else that they do. And as of today, their view is that they reject it. They're saying, we do not want to do this. And in fact, they're getting sued for not wanting to do this. So they're willing to go to court in order not to do this. So let's go to a similar set of two questions that kind of follow on to this. A general purpose CBDC could give rise to higher instability of commercial bank deposits due to a crowding out effect in virtual and real money. In this scenario, couldn't the CB still lend digital currency to commercial banks to supply them with enough funds? I think there's an embedded error, let's say, in this question. I don't think the digital currency is different funds than the non-digital currency. So if you were going to launch a central bank digital currency, you could still keep the Fed window open for commercial banks, and they can still absorb however much funding that they want or need. So I think the answer to this is that it's not going to be that much of an issue. Now, if cryptocurrencies achieve wide adoption, will that lead to an account-based payment system, from an account-based payment system to a token-based payment system using DLTs? In which case, what will be the role of commercial banks, and what will be the impact on the creation of money? Excuse me, it makes sense. First of all, I'm not sure it will lead to a token-based payment system, because if we're talking about something like Bitcoin, I think the average person is still not going to want to hold Bitcoins directly. Just like the average person today is effectively using a bank. It just happens to be called Coinbase to hold their Bitcoins today, because the upside of cash is you have full control over your money, and there's no counterparty risk, and there is no intermediation risk. The downside is you have full control over your money, and if you lose it, it's gone, bye-bye, good night. And so I think this is an unfixable dilemma, because it's the exact same dilemma with cash. If I'm afraid the banks are going to default on my deposits, I can go pull all my money out and get rid of counterparty risk. But then what? What do you do then? If it's $100, it's okay. If it's $1,000, it's okay. If it's $100,000, is it safer in your house? Is it? You're not seeing the counterparty risk directly, but what's the risk that someone steals it? Not zero. And $100,000 is not a lot of money, right? If you're a big company, you're a company that has 200 million of cash in the bank. You say, oh, I'm not comfortable with the bank. I am not comfortable with the credit risk I'm taking. I need to pull it out. Okay, what do you do with 200 million of cash? First of all, the cost of taking it out is not zero, because for 200 million, the best case scenario, you need to build vaults. You need to pull guards. You need to pay their salaries. You need bookkeepers. You need auditors. You need people controlling the whole system. So in practice, when you take out the costs of storing your cash, you're still going to be paying a negative interest rate of some type, right? Because you're getting zero interest on your cash, and then you have some cost to store it. So you're getting a negative interest rate. This actually happened in Switzerland, right? Because rates in Switzerland for government bonds are negative up to, I think, 9 or 10 years. So some big insurance companies did the math, that, we're getting negative 0.3% on our money, and moved some to vaults, and built vaults, and kind of put the cash in there and guarded it, and said it's, instead of negative 0.3%, it's negative 0.1%. We're making a good investment. And That's fine, of course, but it is similar, I think, conceptually, to running your own wallet. A small percentage of people will do it, but I don't think it's going to be the mass market solution for most people for the majority of their liquid wealth. It's too much aggravation. It's too risky. And so I believe most people are still going to use some type of third party to hold their central bank digital dollars. And then because at a bank and they lend it as a custodian, well, it's going to be the same thing as it is now. Right? And someone's going to say, well, if you deposit here, I'll pay you interest. Oh, that's nice. I'd like to get interest. And free toaster and tie and what have you. So I don't think whether it's, if you make digital cash, you change anything about macroeconomics. I think. I could be wrong, but I don't think so. Because you have these exact same dynamics going on with physical cash. So I mentioned earlier negative interest rates, and I'll come back to that. This whole scenario I just described with insurance company, central banks don't like that. Right? They want to be able to take interest rates up or down to implement monetary policy. What we have seen in the last 10 or 15 years is interest rates going far lower than anyone expected, negative, which no one really expected, not causing inflation, the banks wanting to go even more negative. And there is some hard barrier against that, because if they came and said, now for your bank deposits, you're getting negative 5% or something, well, everyone's going to go put up with the aggravation of being their own bank, because the average person is not going to accept that, you put $100, then it's going to become $95. And this is in addition to the checking, the fees and whatever inflation there is. Like literally, they're paying you that much negative interest rate. I don't think the average person is going to accept it. So the fact that, and the reason the average person can avoid accepting it is cash. You can literally say, fine, I would like to store my US denominated wealth myself. And so there is an active discussion by some people in the macroeconomic community where the point of the discussion is, yeah, let's eliminate, there's some that say, let's eliminate cash for AML purposes. And there's others who say, let's eliminate cash so we can implement negative interest rates. So crypto cash generates the same problems for you if you're a central bank. And so I think I don't know, but I believe there will be central bank-backed digital currencies and they will be used. I think they will probably not be totally decentralized and totally censorship resistant. But I think institutionally they will have a hard time launching a cash 2 when they're trying to restrict cash 1. I think we will not dramatically change monetary policy due to this, even though you could. But I don't think central banks actually are trying to change monetary policy. If they were trying to change monetary policy, they have the tools to change more monetary policy now without going through the route of creating a cryptocurrency. I mean, central banks set reserve requirements already. It's one of their tools. So of course they could make them higher. They could make them lower. They could give licenses for full reserve banks and so on. They don't need crypto to do that. They don't do that because they don't believe it's the right way to manage monetary policy. And so crypto, I think, is not going to change their view. And I think part of the reason you end up with central banks being so negative on public cryptocurrencies, it's a combination of the cryptocurrencies, the economic model of the cryptocurrency is so antithetical to how banks think about monetary policy. on how banks think about units of account or stores of value or mediums of exchange. And then there is a segment of the cryptocurrency community that runs around and is like, we're going to show the banks. They're going to be replaced with this new gold standard in effect. And let's leave aside whether they're right or wrong. That annoys the banks because maybe less so because they think it's threatening, more so that they think it's just wrong. And so if you're, I don't know, you're a pilot or you're an aeronautics engineer and you put engines here and you do this and you get thrust and your thing takes off and then someone says, we're going to replace planes and we're going to go this other way. It's a helicopter. You're like, well, that's a helicopter. You're not going to replace planes with a helicopter. And then maybe you will replace planes with a helicopter, but the plane manufacturer doesn't think that. So I've seen this, and I've seen this with like actual central bankers, where when someone puts this, it's going to be the new currency. They're like, of course it's not going to be. If for no other reason than we, the central bankers, are not in favor of becoming, and so we're not going to go in that direction. But if you tell them, like, look, it's a commodity, it's like a stock, it's an investment security, it doesn't actually have very much to do with you. But, no, that's fine. We don't have a problem with that. And if you say, I think the right baby step for banks is to say, well, we will issue some of our own sovereign currency in a way that can be held natively digitally and transacted natively digitally, because that's helpful, but without otherwise changing our monetary policy and the tools we use to implement our monetary policy. I think that could happen. And I think that's going to be their stepping stone in. Okay, many central banks and banks get into crypto with their own stablecoins, e.g. JP Morgan Chase. Couldn't these banks not directly change fiat into crypto? Sure, of course they could. But JP Morgan is primarily in the business of doing transactions denominated in US dollars or euros. And so it doesn't serve any purpose for them. It doesn't serve any purpose for them to convert to Bitcoin. All it does is introduce price risk, volatility. It creates a winner and a loser in every transaction. All right, so if you just want, if I'm a big company in the US and I want to send $1 million to a big company in Europe, if I somewhere convert it to Bitcoin along the way and convert it back, the exchange rate will move some in one direction or another. There will be either a winner or loser on the two entities, or the bank will be the winner or loser. And so it introduces an extra amount of volatility, the transaction, that I don't think is necessary. And by the way, seems like just a random, it's like saying I want to do X and I'm going to add a random lottery ticket on top of X. Right? Someone will win or lose. There's a great article, again by Matt Levine, that I just posted, where he walks through the introduction of JP Morgan coin. And part of what he's saying is, I don't understand it. Because this appears to be a coin today that it is 100% live within JP Morgan. But if it's 100% live within JP Morgan, doing transactions within JP Morgan, why do you need a coin at all, right? You could just do transactions in JP Morgan. Maybe it's a little dipping a toe in the water. And if everyone starts using the JP Morgan blockchain system for inside JP Morgan, maybe the next step is going to be some other bank will use it. It will become progressively more open over time in a way that an internal database can't easily. And maybe that's what they're doing, but it's not clear that's what they're doing. On the face of it, as described today, it feels more like a marketing exercise, less like a technology innovation. But you don't know. You don't want to impute motivations to people without knowing why they're doing it. It might be a way that maybe they do believe someday they'll be making blockchain based transactions throughout the whole ecosystem, and then they're a big conservative bank, so you've got to take your first step, and maybe this is their first step. But I do think in the banks, they will be doing their national sovereign currency transactions denominated as national sovereign currencies, not as something else. If a central bank rolls out a digital currency, what will this mean for the local market? How would, for example, telecommunications companies still be able to use their e-wallet alongside the digital currency? Would the digital currency be just to purchase the virtual money, or would all people stop using that service and go digital currency? Yeah, this is a good question. I would think of the answer a little bit differently than how the question asked it, but I do think it would be a competitor to e-wallets, all right? Because there are definitely a lot of e-wallets now, and the e-wallets are another version of a bank account, and you have electronic access to your money, and you can send it here and there. It's primarily an innovation in user interface and user experience, more so than it's an innovation in kind of monetary policy or banking or anything like that. And once there is a digital central bank currency that's native, well, based on what I said before, most people will still actually use a third party. They will still use an e-wallet. They will either use an e-wallet with standard digital dollars, or they will use an e-wallet with standard crypto sovereign dollars. But some people might just use a wallet. That's not a hosted wallet. That's not a custodial wallet. That is simply your own wallet on your phone, and you put $50 in it. And I think for transactional purposes, the story is different than for store of value. Let me mention it about myself now. If you told me take all my net worth and all my liquidity and put it on my cell phone in a non-custodial wallet in cryptocurrency, that would alarm me. And I arguably I'm in a very, very, very small segment of early adopters relating to cryptocurrency and knowledge about the topic. I mean, I teach a course on the topic, and I still find that concept alarming. If you told me I would have on my cell phone in a non-custodial wallet $300 of digital dollars or digital euros, with all the normal pluses and minuses, like if I lose the password or someone hacks my phone, it goes away, but I can use it to instantly pay and what have you. I think I'm okay with that. I think I'll be fine with that. And the place probably the line at which I would be fine with it is around the amount of money that I'm fine kind of carrying around my wallet anyway, right? So the amount of cash I have in my wallet. If I have $300 of cash in my wallet, I don't worry about it at all. If I have it, if I have 5,000, well, I'll get a little bit more nervous. Like I wouldn't, on a day-to-day basis, walk around campus with $5,000 in my pocket because, I don't know, I'm forgetful, I'm going to leave my wallet somewhere, and then I'll feel dumb that I've lost $5,000. 50,000, it's out of the question, right? There has never been $50,000 in my wallet. Right? I don't know that I've ever like walked around. I don't think I've ever been in possession of $50,000 of cash. Is that a fair statement? Yeah, I think that's a fair statement. Right? And I certainly wouldn't be comfortable with $50,000 of cash moving around the world and conducting transactions. And so I think on this point, because here we're talking about transactions, less about store of value, I think there will be a little bit of crowding out. I think there'll be a little bit of displacement. And that displacement is probably partially displacing e-wallets from banks or telecoms or what have you, and partially displacing cash. And that will be that. I think that will happen. Now, it's a good time to remind everyone of the single most advanced, amazing system of this type, which remains WeChat. All right? This is WeChat is living in the digital future that everyone's predicting in the rest of the world for a very long time, and WeChat is actually doing it. And what is the interesting thing to learn about WeChat? WeChat isn't super successful primarily because it makes payments. You could make payments with cash. You could make payments with a credit card. Coming and saying you now get to make payments with Bitcoin or US dollar coin is fine, but look, you're not adding some exciting new value to the consumer. What WeChat has done is they've built this programmable feed around the mechanism of payment. And so you're not paying, you're booking a car, you're ordering delivery, you're booking a massage, you're unlocking a scooter, and so on and so on and so on. And so you have these intelligent transactions wrapped around a payment mechanism. And that has proven to be very, very successful. And it's very, very successful in terms of utility to the consumer. And it's going to be very, very successful and powerful for WeChat itself, the owner of the platform, because you get an amazing amount of very rich data about what your customers are doing, right? Unlike, like Amex knows that I bought a $100 dinner at this restaurant. WeChat knows exactly what I ordered, which meals, how many people, what dishes, did I get it delivered, and so on and so forth. And so you have this vastly deeper data set, and that's helpful for all the reasons data is helpful, but it's also helpful in that you can better coordinate actual service delivery with this as the backbone. Because if you know that, statistically speaking, 732 people in this part of Shanghai are going to want spaghetti carbonara in the next hour, you can do very interesting things with that data that actually improve utility. And so this is the story of programmable money and using money to do the, here, it's not the money itself, it's programming, right? It's a platform that incorporates money and the programming is around it. But in time, I think Is there an interesting story around these services on an open platform with a programmable digital money underneath them? Maybe. Don't know. I don't know how you get there. But one of the things that people need to keep in mind, if one believes there's going to be a B2C case for a cryptocurrency, a B2C case, one has to look at WeChat, say, oh, right, here's the obvious future of payments. Obviously, the future of payments. It exists now. It's at super scale. People use it tremendously. How is this going to be better than that? Because the question is not, how is it better than your credit card or the cash in your wallet? WeChat is for sure better than that, the credit card or the cash in your wallet. And so then there's an interesting question. Is it B2B uses? Is it institutional uses? Is it settlement uses? Is it special case uses like censorship resistant, which obviously WeChat is not? And so I keep that in mind because we're already seeing the future of payments. The future of payments is in China, right? Like, what is the Chinese payment system today is clearly the future of payments for the rest of the world, and it continuing to evolve. And it goes back to one of these long-standing questions of if cryptocurrencies primarily end up being retail payments or something else. And that's a big, important and strategic question that nobody necessarily knows the answer to yet. Someone asked in the YouTube comments, will central banks come out with digital cryptocurrencies in the next 25 to 30 years? I think much earlier. There are trials going on around the world now. I think we'll see it over the next few years, but I think they will be at least partially permissioned. I think they will not change anything about the monetary model of their countries. I think they will not be permissionless. And as such, they will be convenient and helpful and useful because there are very good reasons why you need or want native digital payments, but they may not be relevant for censorship-resistant applications and some of the more ambitious topics. So that would be my guess on that question. As always, it is super, super interesting topics. I mean, just so interesting. The more you look at it, the more complicated it gets, the harder it gets to see what's happening. You see that there's always trade-offs. You see that people might evolve in different parties, might evolve in different ways. And it's going to be exciting because I think there's going to be a lot of different experiments being run in the space by a lot of different parties, testing a lot of different theories. So we're at the end of our time. I want to thank you all once again for joining. We had a good group for central banking, which people might find less exciting, but I think it's very interesting because some of the key trade-offs are embedded in the central banking questions. Have a great weekend, everyone. Thank you as always, and we will continue next week.